Hey everyone, today we are very happy to have Professor Hoi Ying Wong to give us a talk on deep learning and limit order book trading. So it's my pleasure to introduce you our speaker. Dr. Wong is a full professor at Department of Statistics at the Chinese University of Hong Kong. He is also CUHK Outstanding Fellow and Associate Dean of Faculty of Science. So his research interests mainly include quantitative finance, stochastic control, numerical methods, and machine learning. So he has already published over 90 journal papers and is serving as associate editor of Siam Journal on Financial Mathematics and International Journal of Theoretical and Applied Finance. So other his roles include the consultancy for the banks, monetary authority, and fintech companies in Hong Kong. So it is really my greatest pleasure to receive Dr. Wong in this webinar because he is my PhD advisor. So I still remember I enjoy and benefit from every his presentation. I hope it applies to all our audience today as well. So I would like to ask your full attention to Dr. Wong, and please join me in welcoming him today. So Dr. Wong, so please feel free to begin if you're ready. Thank you.
Yeah, thank you, Dr. Poon. And basically, it is very my pleasure to present my work here. And actually, I promised Dr. Poon to visit NTU many years ago, but afterwards there are many things happened in Hong Kong and also the pandemic, and it's quite unfortunate. So anyway, so let's get started. So let me share my screen. Okay, I hope that everybody can see it. So today I'm going to talk about a deep limit order book trading, and it is a joint work with my current PhD student, Jie Yan. And I can tell you a bit about this background with this research. So about a year ago, I was invited by a fintech company to join them as a consultant. So of course, they've offered me a very decent consulting fee. At the same time, they offer me the most important thing is the data. So many data enable us to develop different algorithms for different kinds of trading. So among many products that we developed, so I picked this one because this one is better illustrate with some of the statistical theories, okay? So in this talk, I'm going to be talking about the trading with machine learning, and I want to describe in particular for the limit order book and about this our algorithm specifically. And we can look at the empirical results, and actually that has been put on trade. And then we also do some explanation, try to explain under what circumstances it works and whether or not we can improve it. So let's get started. So in terms of trading, basically we have a relatively longer term of trading. So we call it inter-day trading. So that means we only trade in days. We don't trade several times in a single day. If we trade many times in a single day, then we call it an intraday trading. And I call it a short-term form of trading in here. And in most of the time for short-term trading, because it should be executed in a very speedy manner, so most of the time is executed through algorithm or computer. And people also talk about algorithmic trading for this kind of intraday trading. Among many intraday trading, probably one very fascinating one is the high frequency trading. So high frequency means that we do transaction within a day many times, probably many times, lists, and it depends on the data in the following manner. So it could be intraday trading, but low frequency, but I'm talking about high frequency. For low frequency one, probably people would analyze the data based on the stock prices. So the stock price may be, the stock price that we understand in low frequency is like the stock price that you can quote from the internet. So it could be daily open price, daily close price, daily highest, daily lowest, and then also the volume of that day, etc. That will be the data that constituting the trading decision in most of the time for low frequency trading, for low frequency intraday trading. For high frequency, so it is not only one price. Actually, we will look at the limit order book. So I will show you what do we mean by limit order book later on. Or if you really do it more carefully, we even can look at message book. So that means we can look at which broker or which trader put the limit order, okay, in a more detailed manner. So in terms of high frequency observations across the day of the liquid market can equals to the amount of the daily trading data collected in 30 years. So you can imagine how many data that we are going to look at on a single day. So even for a single stock, in particular, actually, we are looking at more than one single stock. Okay, then we can take a look at this. And talking about limit order book, actually, there are many research. So I can divide them into the following sense. So the first one probably is using statistical model or stochastic models. So people assume that there is some stochastic model describing the limit order book movement. So like the Hauke process and whatever. So once you fix a model, you look at the data, let the data train your model, and you believe in this model, and you do the remaining part of this. The second part of the financial modeling might be data-driven models. So we do not specify any stochastic processes. We only solely look at data and let the data tell us what happened through some machine learning framework. We do forecasting, we do like the accuracy of the prediction, okay, etc. But in most of the time, I would like to cite all this work, okay? For example, the first work by Lapointe, published in 2021. So this work is published in the Journal of Financial Economics. So it compared many different machine learning algorithms for low frequency trading. So we look at the fundamental analysis, and they conclude that machine learning is useful because it can extract non-linear information. For limit order books, so this paper published in IEEE Transactional Pattern Recognition. So this paper analyzed the forecasting of the mid price from the limit order book. However, later on you can see when we do dealing with trading, mid price is not that important. So because when you do the transaction never really take place at the mid price, or very less frequently take place at the mid price. And it is their early papers of developing that framework or using deep learning. So seemingly that up to now, there is no work that is really contributed to the trading of limit order book can really take into account transaction costs and all the practical issues. And it is one of the targets of this paper. And at the same time, recently people would like to argue whether or not machine learning is really useful in finance. Would it be explainable? So these two guys published a paper in EJOR on the use of machine learning in credit risk. So they find out that, so sometimes you can take into account some explanatory power of the machine learning algorithm for credit risk prediction. But again, it seems like the machine learning or deep learning for limit order book, whether or not we can establish the statistical reasoning seems still lacking. So after this consulting work, there are many stimulating ideas so that we try to combine these kind of things to see whether we can have a more academic contribution to that. So in this paper, what is our major contributions? We try to develop a novel deep limit order book trading system that take advantage of tick time intervals. So later on, I will focus on what do you mean by tick time intervals in the Chinese Asia markets. That is very specific. Using deep learning and GPU parallel computing techniques so that we can do the following things altogether. One, generating trading signals. Second, after we have these trading signals, we optimize the signal to see how can we determine the optimal allocations of our money according to these signals. Finally, we execute the order. Okay, we have to put the order into the system, and then we do a real world trading. So it is the first objective about the development of this kind of system. Second, after we develop the system, so before that, actually we try many alternatives, and we want to understand why ultimately our system works better. So we try to use some statistical methods to explain why such a deep LOB trading system may work better compared to other algorithms. And on top of that, do we have improvement based on the statistical reasoning? Okay, so let's take a look at the data. It is one snapshot of a limit order book data. Okay, so it is not a single number for limit order book. So for this snapshot, so we just take a look. For example, the orange part is the ask price. That means the price that a trader willing to sell their stocks. And you see that it is one order. Okay, this is one order saying that, so a trader would like to sell the stock at $20.29 for this volume. And there is another trader want to sell the stock at the same price with different volume. Then maybe a third trader want to sell the stock at 20.33 with different volumes. Okay, now you can see people want to buy the stock at a lower price. So the blue part is the bid price. That means people want to buy the stock at this kind of distribution of volumes of price. And there is a gap. So if there is no gap, then the trade is mutually agreeable, and you can make the trade. So probably at this point of time, we receive this kind of data. Actually, it's longer. So we have the jargon. So for this limit order book, so it is called the level 1. So there's level 1, ask price, level 2, ask price, etc. And so here are 5 level data. So in practice, actually, we got more than 5 levels. So typically 10 level in particular. So from this time point to the next time point, it will be a very short period of time. So it could be like a milliseconds, nanoseconds in the Western markets, but in the Chinese Asia market, it also take like 1 second to 3 seconds. Okay, so it's not that fast in the Chinese Asia markets. So in the next time point, you can see, so this part of the volume get consumed. So it becomes a new set of a limit order book data that received in the next time point. Okay, so the limit order means that the trader would submit their price and the volume of their price for buying or selling. So it is called the limit order. Another is called market orders. Market orders like, anyway, I want to buy this stock. I want to buy this stock for this volume, for instance, no matter how much, then the system will automatically give me the level 1 prices to match for me, so I can get the stock right away for this kind of price. Then it is called the market order. So I do not fix the limit of my order, I just find it. So after this market order, so the volume get reduced. Now, I want to introduce this parts of market order and limit order because our strategy is actually a market order type. So that means we look at the limit orders, and if we find it is favorable to us, we will put into a market order to take those prices immediately so that we can really guarantee the transaction. In many academic works, people look at this limit order data. Finally, what they want to do is that they want to do after, for this part, they look at the mid price. They want to forecast at the next time point, what will be the mid price. The mid price is like the first level bid price and first level ask price. The middle of them is called the mid price. Forecasting the mid price may not be able to secure your transaction actually. So what we are going to do, we are not going to predict the mid price instead. So we are going to generate signal whether we should put into a market order. So when I submit the order, we have to pay transaction costs. Okay, so we want to make all these kind of things together. So more on the data side. So therefore, it is a very massive data. You can see that. So the shape of this data can be like we have T. So T is the number of historical days. So we have to pick up a historical window for our forecasting purpose or estimation purpose. S is the number of stocks. So we are doing the forecasting not solely on a single stock. So typically in the Chinese A-share for our empirical study or for our training, there are around 4,000 stocks, okay? And times of 4,800. So it is the amount, okay, that we have, okay? So the size, when we download the data size, okay, every time point, so every day. So we got more than 5 gigabytes of limit order book data for around 4,000 stocks per day, okay? But basically we need a longer day. So there are lots of statistical concern. First of all, because of the dimensionality. Dimensionality means that the data itself contains like 10 levels, right? 10 levels, that means we have each of the level of the volumes, which level of the prices, so all their numbers. So it is a multivariate nature, so there may be overfitting, very noisy, because the model designed to extract useful information, sequential time series, so because when we want to execute trade, so we move the things forward. So most of the time you're using a rolling window basis method. And this kind of things also affect the downloading size and the computation of the whole things. The label is kind of multi-classification. So it is kind of artificial in our execution. So we have to label them into long, short, and none. So these 3 categories. So for long means that it is a buy-in signal, and the buy-in signal is strong enough to compensate for the transaction costs that we buy in. And at the same time, we plan that after we execute the long position, because it is the high frequency trading, actually we want to unwind the position in a short period of time as well, so that this trade should be good enough to compensate for the transaction costs for buying and selling such a stock. So they have to take all these 2 things into account. So they have to label them, whether it's a really good buy-in signal, is that the stock will move up, okay, will move up, and this move up magnitude is good enough to compensate for the transaction costs that would take action afterwards. So this is the labeling that would affect the multi-classification problem. And also, after we classify them, given the market situation, we encounter imbalanced data. That means the buy-in signal may not be the same as the selling signal, okay? Long signal and short signal are in imbalance. So the imbalance of this signal led us to think about what would be the loss functions that associate with this. So we have to pick up the loss function carefully. And so transaction costs are non-trivial. The spread cost by taking market order, which ensure the execution. So the spread cost means that the level 1 ask price and the level 1 bid price, there's a gap. And there's this gap, we have to compensate for this gap in order to make the profit. So the spread between the bid and the ask is also a part of the cost for us, okay? And whether or not we have sufficient time limit for one trade signal. So once you receive this signal, you have to execute it. We have to execute it rapid enough. Otherwise, this kind of good position probably gone because other traders may take it out, okay, as well. So now, let's do some labeling. So the data include the ask price. So let's say this is the price of asking, the volume of ask, the bid price, the volume of that bid, okay? So levels, we have 10 levels. So in the Chinese A-share markets, the good thing is that one tick between another, the ticks between the others is often like 3 seconds on average. So unlike other markets, if you look at the Nordic stock market here, so there are 100,000 daily ticks per stock. For London Stock Exchange, it's even higher. It's like 150,000 daily ticks per stock. So that means the times between each tick is very, very short. So during this period of time, there's no computation is allowed for us to optimize our decision making. For the Chinese A-share market, it's good. There's 3 seconds. And these 3 seconds enable us to do a lot more things. So we can do some computation and optimization within these 3 seconds. So remember, 3 seconds is long, but not very long. Remember that we have to submit our trade to the system. So actually, what should we do actually? We have to complete everything within half a second. So that's the talk's title, why half a second, please? So we need an algorithm which can complete all the predictions, signal generations, optimization, and all the submission to the system within half a second. So it's a typically requirement that the challenge that we're encountering. So now we can see that in this regard, we have 4,500 to 5,000 daily ticks per stock, and we have 4,000 stocks actually. And we can see the data is like, so this is the time that we record. So we record the limit order book data in this way. Okay, typically if we do not rearrange the data in certain manner. So just think about pure stock, the ordinary low frequency data. You record the stock price. When you make decision, probably you can look at the current stock price or the moving average of the stock price over the last 20 days, 30 days, etc. And also the volume, right? So that means we collect the prices at different time points, and we also manipulate all this kind of data. So that means in limit order book, it's almost the same. We have this data, but actually we also look at the historically how they are managing. Like, do you like to look at the moving average or whatever quantities that you're interested in? So here is the source data, but actually we also have some manipulation of the data set so that we can extract more information. So now talk about the data set. To do such a consulting work, the best thing for us is that we can have this really huge data set provided and cleaned. Even though you want to really do a limit order book research, I think the first obstacle will be the availability of the data. Before this project, I tried to buy limit order book data from vendor, but after I sent our request to them, even though we send it, we're willing to pay money, they do not respond to us, and eventually we didn't get any data from those vendors. But here the company provides us with this very huge a very long series of historical limit order book data, so we can really investigate on it. But ultimately, we also want to publish a paper. They provide us data, but the data is proprietary, so we cannot share all this data. So in order to write a paper and we want to do a more scientific justification, so we go through these 3 data sets. So the first data set is the simulated data set. According to the literature, some paper can generate simulated limit order book data. So we base on the simulated model and see what happened to our algorithm, so that one can verify our algorithm from this simulation. Second is the benchmark real data set. Fortunately, we find out that there's a paper recently published containing 20 stock data, limit order book data from the Chinese Asia market as well. So 20 stock is very limited, and it only covers very short periods, consecutively 4 months. So that data set enables us to demonstrate our algorithm, and one can cross-check and cross-validate whether they can reproduce our result, at least for these 2 data sets. And finally, in our paper, we contain a proprietary data set. So we select 100 stocks out of 4,000 stocks, and to look at different kinds of performance. Because we find out the following is that our model later on can generate trading signals. And we find out that the stock which is more suitable for high frequency trading would generate more signals from our system. So it means that we can rank the stock whether or not they are performing well for high frequency trading according to the number of signals that generated by our algorithm or trading platform. We use that to rank those stocks, and we concentrate on those good performing stocks. Now we pick 100 out of them. This 100 is not the best of 100. So we divide them into 4 different groups. So they're containing very good performing group, intermediately performing group, and the worst performing group. So we intentionally select this 100 data set, and each group contains 25, so that we can take a look at when it is very good, what happened, bad, what happened, etc. So it does not cover the 4,000 stocks, because if we present all the 4,000 stocks, result would be very heavy in terms of writing a paper. Now, going back to our algorithm, okay? So first of all, we have to label our signals. So to be long, short, and none. So look at this picture. So we try many different algorithms, and finally we make use of a deep CNN model. So the idea is like the following, like the image processing. So we can label the picture. If we provide a picture like this picture, so label it. For the labeling step, you say, hey, it is a cat. Okay, and if we have this picture, we label it is not the cat. Right? Now we have our limit order book data. We can have all this number mapped into the heat map, and this heat map is like this one. Okay, so we can see with this picture, we find out that the outcome would be a rising stock. So it is a long signal. This pattern is a short signal. So as a human being, we don't know. We cannot really recognize why it is long, why it is short. But in a computer's point of view, this picture and this picture are equivalent actually. So for the computer, it doesn't carry any meaning. So that means we convert this data into pictures and use the pictures recognition problems to classify our input. And for no matter what model, for example, the CNN, even though it's the input, okay, you train it, but after you train it, even though you input the same picture into the system, it would output the probability whether it's a cat. So the probability of a cat, for example, this picture is 0.9. If you input an outsample picture into it, probably also can offer you a reliable result. Or there's a 0.6 probability that it is a cat. And it is only 0.2 probability that it is a cat, even though it is an in-sample. So out-sample, very low probability being cat as well. Now, for our system, it's similar. We can input in-sample or out-sample limit order book figure, and the deep convolution neural network will produce the probability of signal, whether it's a long signal or short signal, with certain probabilities. All right. So here is the entire idea of a system. For the first part, when the limit order book data get into the system, we normalize it, we label it, and then we train it by the CNN model. And we would do it on a daily basis or weekly basis. So in practice, we only update our model on a weekly basis. So this procedure takes very long time, actually, probably a day. So we would do it in a weekend, okay? So we train the model. So once the model gets trained, so now we can put into execution. So put into execution, this model after training, the execution computation is very rapid. So it's like 0.01 seconds, something like that. It's very quick. So that we can make use of this model, and the new data come in on a daily basis. So the limit order book data come into here, normalize it from the system, use this model for the prediction, and then we can predict the trading action. So we divide it whether we have signals or no signal, okay? So, or the signal is strong or not. And then use this signal, we do the optimization to determine our position. So here's the optimization. So the optimization should be done also very, very quickly. And then we determine the position, and then the current trading price and the target price, okay? And then we have the timing with the trade and see whether we get a profit. If the situation deteriorates so badly, we also have the cut loss algorithm. Okay. If no suggestion, then we keep the original position that was no trade, or keep the original position. And then we move to the next time point. So we see that it's a comprehensively, we have developed a system in this regard. And the training procedure is a very long time, but during the daily transaction period, no training is needed, okay? We train it already, and then we just put it into execution to computation. Now, we take a look, actually, we tried many different methods. We tried classical, like logistic regression, support vector machine, classification regression trees, a random forest, etc. So those methods has been tried by others, but ultimately we find out that the deep convolution network performed the best, okay? So here is roughly the architecture that we do. So we normalize the data, okay, and then we submit it into a convolution layer, and we have the inception module, and then you're using the long short term, the RSTM to do the forecasting, and then we output. Of course, there are many fine-tuned details I want to drill into it, but basically it is the idea. Then after that, we have the imbalance classification. Because it is the imbalance, in the literature, people use the cross entropy loss function, and we find out that it is not very useful. We'd rather find out that the vocal loss function for imbalanced data would greatly improve our performance in terms of trading profits. And also, according to this paper, okay, Savinalo and Ramakant, they find out that in terms of limit order book trading, there will be certain universal features in limit order book. Okay, so we can pull some stock together for training purpose. On top of that, we want to compute the optimization during the procedure. But this optimization should have a very clean and simple formula so that we can compute in a very rapid manner. So we adopt the value at risk, okay, as the cut loss criteria, and then we use the carry growth criteria as our target, subject to the value at risk constraint. So we solve this optimization theoretically, and here it is the solution for the long. Of course, we have the corresponding position for short. So we have the number of assets that, number of money, amount of money that inputted, or percentage of money inputted into the long position according to this formula, which can be rapidly computed based on equation 2, so that we can do the optimization as well. Now, we also need some hardware to help us. So we do it during the training procedure, we need parallel computing. So very fortunate that we have the GPU platform. So because recently I also invited by the NVIDIA to collaborate with them for certain parallel computing services, consulting work over there. So I learned, okay, actually I can make use of GPU computing. And these days, actually, we are using this, the NVIDIA A100, and the computational time is only like this, like 10 hours, okay, to compute our tasks. So this actually enables us to do the training on a daily basis after the trading period, or we do it on a weekly basis. Now, let's take a look. So after all, the data, so after the training, during the trading procedure, what is the times that we really take? Data normalization is almost like take 1 milliseconds. One-step prediction by our DCNN functions is almost like 26 million seconds. The optimizations that I just mentioned is cost like almost none, 0.005 seconds altogether. So anyway, these three summed together is only take like 0.03 seconds, okay? And then you still have time for us to submit the order. So we truly execute everything in half a second, okay? So the gap of a longer than or close to 0.5 seconds is adequate to implement our system, or there are some daily operations mistakes, okay, that we can fix it. So we are confident in implementing this system and obtaining considerable returns, actually. And probably I can show you some empirical result. So this one is that we simulate the upward trended daily order book, downtrend, and flat. So we try to analyze this market sentiment. So now you can see, use the vocal loss function. So this one, the blue one, is only use the signals, okay, without doing any change in the vocal loss function, without any optimization. It's the blue one. It's making money, okay? But when we use the vocal loss function, we make more money. When we use the optimization, oh, you can see, okay, actually the performance is really good. So for uptrending market situations. How about for downtrend? Downtrend would limit the profit actually. But anyway, still the same order maintains, okay? So that means if you use the optimization and also vocal loss function, it's also improve a point solely use the traditional method. For flat, still, so our methodology is making money. So it is only from a simulations point of view, okay? And this graph is also telling us over upward trend, downward trend, and flat. So this enables us to look at different sentiment, because people will argue now if we can make a huge profit solely because the market is performing so well. So we are generating different scenario to look at what happened here. Now going back to our true data set from our 100 stock that we selected over these 4 groups. Okay, so now you can see it's very simple. This is the profit per signal per day. So that means we suppose that for each stock, we only trade one time. We do not do multiple times, okay? On average, if we only do 1 time a day, how much profits we can make? Why I consider only doing 1 time a day? Because in the Chinese market, they do not allow you to buy the stock today and sell at the same day. If you buy today, you must sell tomorrow. So we cannot do this kind of intraday trading. But for a firm which is holding a fund, they have the stock on hand, then they are permitted to do selling, right? So because they can, like, I buy in certain stock that I already have certain stock over there. So if I buy it, I can have the stock that I purchased it yesterday, so I can sell it out later on today. So in many times, in such a circumstances, because of the market friction, sometimes we can only do trade on each of the stock once, typically. Of course, some big firms can do more than one time trading, okay? Because they can split their signals into very small trade amount. So suppose we are considering in the worst case scenario, we can only trade each stock 1 time only. Under such a circumstances, our performance over this 100 sample, 100 stock, accumulate up to approximately 25% annual return. Okay, it is the worst case scenario actually. So if you really look at the trading profit, it is much bigger than this number. Okay, so on average, actually we can make like 30 bips on a single day for each stock. And now it is a real data performances, okay? So we can see there's 4 groups. Group 1 is a very good stock that according to our ranking, that means there are many signals, more signals, meaning that it's more suitable for high frequency trading. So you can see that, so using our algorithm, it is the profit and it is the confidence interval, okay? Without our method, just using the DCNN prediction, okay? It is also a method without doing optimization, still making money, and it is also the confidence interval. So doing the optimization would earn much more. For second group, okay, so you can see there are 3. This one is without the vocal loss function. This one with the vocal loss function improved with optimization. Okay, so you can see the worst case is the group number 4. So even though like this, we can see clear that our algorithm performs better, even though for the confidence interval, there are overlaps. So all in all, that means our algorithm seems working quite well. And actually, we are really putting it into practice so far. And you can see for different groups, So after we adjust for the optimization, so the average profit is almost like 9.64 bips, okay, for each trade. After we taking care of the transaction cost, okay, we subtract all the transaction costs already. So every trade you get 9.6 bip. This is a huge amount on a daily basis, okay, for each of the stock. And even the group 4, the worst one, after we do the optimization on average, we can make the 5 bips. Of course, the variance a little larger at the same time. Okay, great. So next is that why I want to explain why this system can perform well. So like this picture. So we want to develop like the p-value types of things to diagnosis where the features, because we have a lots of features, input, 10 level prices, volume, their changes, whatever. So which feature contribute the best? So in this paper, it's established a statistical procedure for black box models. So typically useful for the machine learning. And this paper in EJOR also explained the prediction of loss given default by a black box model as well. So we can also develop similar things for the p-value of this kind of features. We want to see which features is really important and why the deep learning performs well. So the ideas look like which region of the brain is functioning, okay? So we divide our data into the following type. The first one is the raw limit order book data, what we call it X1, okay? They are the prices and volumes. Second is the order flow. Order flow that means we compare the limit order book data from one time step to another to see the change of volume conditional on the price change level, okay? So we call it the order flow data. Time inconsistent data set like the spread, the mid price, etc. Time sensitive data set is the price and volume derivatives. Okay, that means the sensitivity for each of the levels. So we see whether which one of this one would trigger the trade or trigger the brain. This brain is our neural net, okay, to make a decision of long, none, or short. So here is the definition of the order flow. Okay, so we developed the hypothesis testing as follows. So we define the X, okay, to be a subset feature to predict Y, for instance, and as complement to be the complementary set of this feature. And so if we then replace the value of XS by 0 to see whether it is significant or not and get the masked feature. All right. So now, after all these kind of things, so we select a loss function. The loss function is the focal loss function that we use. And the significant test, we set up the following hypotheses. We see whether the loss function having the feature or without the feature would perform the same in terms of the loss versus the alternative. Okay. And then based on this data set, we can set up the one-speed test statistics based on our loss function. Okay, and then we use the asymptotic distribution of this one. And so this P is related to the normal distribution density. So I skipped the detail anyway. So p-value is good, but we cannot rely on the diagnosis solely based on one single measure. So we also look at the out of sample R squares for the exponential power. So the R square can be divided into two parts of the R square. The first R square is based on the vocal loss function error. The second R square is based on the classification, the classifier, okay, the area under the ROC curve as another criteria, okay. So we have multiple statistical check to see whether the system works well or under what circumstances the system works well. And we check against the following methodologies: logistic regression, support vector machines, random forest, DCNN. Okay, so anyway, I skipped this slide. So I think I have to concentrate on this piece. Now, for example, let me take a look and explain. So this picture is typically for the logistic regression, okay? So the p-value, the smaller the p-value, the more the significance, okay? So it is not a scientific check. For scientific research, typically the p-value should be less than 5% or 1%. But for economic or profiting algorithm, we don't need such a very small p-value. In my opinion, the p-value less than 45% should be sufficiently good. But for logistic regression, you see, the p-value is so large. So more or less is by random. And also it is not consistent. Not consistent means that we look at the R square. So we rank the most significant factor. So in a downward manner. So we expect that the significant graph is decreasing like this, then the predictive power of R square should be increasing, right? So if it is the case, then it's called a consistent classifier. And it is very simple seeing that linear, the logistic regression is not consistent, okay, at all. And actually it shows that it is completely doing nothing. It's something like a random trial. For support vector machine, it's the same. Okay, it's a little better. They identify one factor less than 45%. So it's a decaying, but here you still cannot find the shape like this. You see the DCNN. So the p-value that we compute, okay, most of them is less than 45%. Okay, and the shape is not exactly, but not so poor. So the more significant the factor, the better improvement in terms of R square. It's almost consistent like this. Okay, so you can see the nonlinear feature of the DCNN would be able to extract the information in terms of significance and the predictive power quite consistently compared to alternative methods. And this one is random forest. Random forest is very interesting. It identifies, using this method, 4 features are really highly significant. And the R square is also positive. Okay, but some of negative, right? So it means that it also like these features, decreasing and increasing. So random forest is not that bad. And in particular, it can identify some features. The bad thing is that it is not as good as the DCNN, because for the R squares, DCNN always offer us, no matter which factor, is a positive R square. So that means it improves. But for random forest, sometimes it distracts, okay? But it still can find out some good features. So this enables us to explain why the DCNN might be better in terms of p-values and R square. And we also think about the random forest also has its advantage. So our new idea is the ensemble learning. So we try to do the backing between the random forest predictor and the DCNN predictor. Okay, we assemble these two together. So in short, because I'm lacking of time, after we combine them, we see that after we assemble the model compared to our original DCNN, the profit per signal increased from 27 bits to 32 bits. So we are able to further improve it after we're checking all the features. Okay, so in our random forest, because only these 4 features are really very significant, so we do not train the rest. Okay, we're focusing on training of these 4 and integrate to our original DCNN for the backing purpose. Okay, so I try to conclude it. So we propose an integrated deep LOB trading system, which is new, that we never stated before. We make use of the advantage of the Chinese Asian market so that we can complete it in 0.5 seconds. And there are huge profit and frankly, actually. And we also explain why it works by developing certain p-values and R squares for that purpose. And we discover after we do the significant tests, we can do some ensemble learning as well to further improve it. If you like, you can take a look at many relevant recent advances on the deep learning used in finance for trading purposes. Okay, so thank you. So I better end my presentation here.
So thank you, Dr. Wong. So thank you for this very interesting talk. Okay, so I think we have about 10 minutes for Q&A. So any questions from the audience? I think it will be good if you can unmute yourself and then just ask. Or if you want to type, that is also fine. I can ask on your behalf. Any question, any comment? Perhaps I ask first, and then you know, during that time, perhaps our audience can wrap up some questions for our speaker. So I wonder some details about the prediction part. So you would use the limit order books to predict the uptrend or downtrend or none. So how many books that you use? So I guess you refer to one book for one. I mean, one. Sorry, I should say the limit order book at certain moment, and then after 3 seconds, there may be another new book. So I'm talking about how many such books you use to predict the trend.
Okay, so when we do the training, okay, when we do the training, we train the system. So when we do the training, it's almost like the past 60 days.
Past 60 days, then that there will be a lot of books, right?
Yeah, a lot of books. Because one day consists of like, so one day the data is almost like 30 years data. You compare it to the daily observational stocks. So it is a very huge data set. Okay, then after we train the system, okay, after we train the system, so you can refer it like, it's like a black box, okay, the black box. The black box is almost like a Markovian model. So when we put into the implementation, when the new order book data get into the system, the system would automatically convert it into like a picture.
Yes.
And look at this picture, whether or not they will classify it to be a long, short, or no signal. Okay.
But this signal is for how long period in the future? So long for, how long?
Very short, very short.
Very short.
So very short, because in most of the time, we don't want to keep the order for more than half minutes. Okay.
Yes.
So if it does not successful, we have to unwind it anyway. So so also due to some limitation of the Chinese A share markets, because suppose you hold certain stock, okay, on behalf of your client, by the end of the day, you have to make the total number of stocks same as the stock numbers that on the initiation of that day. And when you buy a stock, you cannot sell that stock immediately. So you can only sell the stock that you purchased yesterday or previously. So there are lots of limitations. So that's why we cannot hold the stock for a very long time. And we don't really want to hold it overnight.
Yes.
Because that would be very, very risky for limit order book trading. So there's a time limit. Yeah.
I think it's linked to how you label the uptrend or downtrend and so on, right? So
exactly.
So there is linked to the whole formulation of the prediction. So the reason why I ask is that now you present a framework, and suppose that the A-share market, Chinese A-share market, is going to improve their trading frequency. I mean, their execution, like less than 3 seconds, reduce it to 1 second and so on. So your data will get much more, right? No matter for training or for the inputs, then somehow we'll encounter kind of the curse of dimensionality or blessing of dimensionality. So what will be your opinion on this? Will it be an advantage, or how your framework can be further improved to incorporate the improvement?
Yeah, very, very good question. So basically, so if it depends on how frequent that they improve it. So first of all, if they just really increase the frequency very dramatically, then we think that we have to cut the historical data short. So we don't need that long period of time, and probably only keep like the last 5 days, might be. Okay, so it's the first thing. Second one is we also prepare for that, and that's why we do the significant test. We want to screen out the features. So which features is really important when we do this kind of thing. So if we encounter the curse of dimensionality, then we can throw away the unuseful features during the training. So we also prepare for that. One more important point is about the labeling. So when the market situation gets changed, the trader would inform us what would be the market restriction. And that market restriction would also change our labeling sometimes. Because when you label it, you have to know whether you, after you do a long position, whether or not you can really realize a gain due to the market friction. So the labeling part is actually need some update. If the market changed the rule a little bit, then those labels will have to change accordingly. So what here I presented is the idea. Of course, I cannot disclose entirely the proprietary setting. Yeah.
Thank you. So before I ask second question, any questions from the audience? So my second question is about the execution of the trading strategy. So I noticed that the most time-consuming part is actually the optimization. So I may miss some part about that. So why the optimization took a long time? Because I saw that you derived the W for longing, something like that.
No, optimization doesn't really take too much time. So the most time taking part will be two. One is the data normalization. So when the data gets in, you have to normalize the data into the one which can be input into the trading prediction system. Second is the prediction system itself. Even though you train it, so we train it like 10 hours. So there is a output black box function. But this output black box function, we train it by Python. Okay, so after you input into it, it still takes time to compute the outcome for the signals. That also takes time. Optimization actually costs very, very little time. It's like 0.004 milliseconds. So because you see our formula is very easy to handle.
Yes.
So we don't want the optimization increase our computational time actually.
So would that mean if, let's say, the market doesn't allow for half a second, may only allow for 0.1 second or so on. So we need to think of some other ways to handle the data. So because now the GPU usage is mainly for training, but not for those kind of data handling. But okay. So
but of my speculation, I didn't check it. So I'm wondering if these frequencies is very high. Okay. Actually, no method can do the signal prediction within the nanosecond. So no matter which method, you have to wait. So what I mean is that actually we don't really need to fully execute the trade within nanoseconds. Probably you still wait for like 0.01 second, okay? And then you execute the trade, probably is still profitable. I didn't check it. So I want to verify that from the London exchange market data. So I try to buy this data from Lobster. So once the data provider, but they never get back to me. They sold the data to American universities, but I want to buy the data, they never sell it to me. So I never check it. But my speculation is that as long as you compute it fast enough, so too fast meaningless. It's too fast, nobody can make it. Nobody can do the prediction. So it's competing against your competitors. Right.
So I think it's like when we do the image processing, sometimes we use a 4K image, but lower resolution image may also work, and even make the model, fit better.
Exactly.
Right.
Exactly.
Yeah.
So we are also, so when we tuning our DCNN model, we also recognize something like that. So we do not use a very high resolution types of prediction actually.
Yeah.
So it depends. So as you play with this game, there are lots of dirty tuning so my PhD students is working on that. Yeah.
Okay. I actually have the third question, but any question or comments from the audience? Okay, so I think I think the last one, my last question is a quick one. So I wonder, the last evaluation of your trading strategy also needs to put, or sorry, I mean paste the order, right?
Yeah.
Will that, affect the limit order book as well? I mean, when you try to evaluate the performance of your own trading strategy, your trading strategy will also have kind of price impact to the limit order book. And have you taken this into account, or that is in your research agenda and so on?
Yeah, that would be on the research agenda, but practically, so it's a very, very good question, actually. So we also talk to the trader. So there may be some price impact as well. Okay, so the number that we reported is almost like on paper trade already. So when we do the paper trade, the volume is not very huge. So the price impact could be ignorable. But if you really want to put a large part of trading, the price impact would be a matter. But so far, how can we resolve this problem is that we listen to the trader. So the trader would let us know. So what is the maximum amount that you can put in? So don't over that to minimize the price impact. It's only by experience, not scientific research. So the next part must be the price impact part. Yeah. So I admit I didn't touch this.
Or can be adjusted by simply increasing the rate of proportional transaction costs, make it more difficult to have a good trading signal or less trading signals. Yeah,
exactly.
Being more conservative. Yeah.
Yeah, and also we can be more aggressive. For example, now our strategy is that we have a good signal. We input a market order to take all the orders, right? But actually, you can do it a little bit more aggressive. We also put a limit order closer to the mid price to see whether you can complete a better trade. But we didn't consider that because there will be some liquidity issue that out of our control. But in practice, actually, I think that part is also doable. Yeah.
Thank you. So I do have further questions. So any other questions by the audience? Okay, if no, then let's thank our speaker again. Thank you, Dr. Wong.
Okay, thank you very much.
Yeah, thank you very much. So perhaps let's call the end of this session. So hope to see all the other participants again in our MAS seminar series. Thank you very much.
Thank you very much. Bye-bye.
Thank you. Bye-bye.
Bye.